Hello and welcome to a webinar on navigating the real estate market. Whether you are a prospective home buyer, a current owner, or simply interested in the intricacies of the real estate landscape, you have come to the right place. Now, for a quick introduction, my name is Neil Joseph and I am an independent mortgage agent with Mortgage Alliance. I have been in the industry for about 5 years now and I have been investing in real estate myself for over 2 decades. Today, we will be exploring the multifaceted world of real estate, from understanding the current state of the market to navigating the home buying process and debunk common myths surrounding mortgages. Whether you're considering purchasing your first home, upgrading to a larger property, or investing in real estate, this webinar will surely have some takeaways for you. Over the next hour, we will cover a range of topics, including the state of the real estate market, particularly in the Greater Toronto area, explore the budgetary considerations and ongoing responsibilities associated with home ownership, walk you through the home buying process step by step, discuss the various types of lenders and mortgage products available to home buyers, as well as common misconceptions surrounding types of lenders, mortgage eligibility, and rates. Explore the assistance programs available through the federal, provincial, and local levels. Highlight common pitfalls to avoid when buying a home, and we'll debunk a few myths about mortgages and lenders. Before we begin, I encourage you to grab a pen and paper or take notes on your device to jot down any questions or insights that arise during the presentation. While we don't have a live Q&A at the end today, you are welcome to reach out to me with any queries or feedback following the webinar. Without further ado, let's dive in and embark on the journey together. Thank you for joining me, and let's get started. Before we proceed to the presentation, please acknowledge that this webinar is only for informational purposes, and you're advised to seek professional advice before taking material steps. Let's start by discussing the current state of affairs in the Greater Toronto market. As you can see from this graph provided by the Toronto Regional Real Estate Board, over the past 3 decades, we have seen a remarkable growth in home prices in GTA. While the price growth has not been exactly linear, there have been bumps, small and big, along the way, but the direction is still up. This is in line with the long-term trend in real estate prices, which have tend to remain at or above the rate of inflation. If we look closely at the average price growth since 1994, it has been just about 6%, outpacing the consumer price index growth, which has hovered around 2% over the same period. This indicates that we have had a robust and steadily appreciating real estate market. You would also notice that the rate of growth has been faster in the recent years, and it would be fair to assume that the rate growth could temper or slow down in the coming years. However, the probability of us getting into a long-term decline in prices is very low at this point. Contrastingly, the rate of growth in the rental expense has been around 3% between 1990 and 2022. This makes home ownership a compelling option, at least to me, and let me explain. Shelter is one of the biggest costs that any individual has to carry on a month-to-month basis, and for me it is important that you can control it. That is not very likely when one is renting and hence exposed to annual increases in the cost. So I encourage you to leverage this balanced state of the current market to consider purchasing your own home if you're financially and mentally ready, as it presents ample opportunities for investment and stability. We will explore more about the readiness aspect later in the presentation. Now let's dwell into the financial aspects of home ownership. Owning a home comes with a range of costs and responsibilities that extend far beyond the initial purchase. Your monthly expenses could include mortgage payments, which include repayment of principal borrowed, as well as ongoing interest costs. Do note that in Canada, we just have short term financing, which means your contract with the bank or the lender will typically be for 1 to 5 years mostly, or in some cases, it may be up to 10 years. This is unlike the US or some other countries where the contract is for the entire repayment period of 15 to 30 years. Subsequently, we have electricity or hydro, as we call in Ontario. Then comes property tax, which is charged by the city. It's usually about 0.5% to 1% of the assessed value of the property. Next up, we have water or garbage fees, and this is typically based on usage. Then we have property insurance, which is a coverage against loss from fire, flooding, etc. This is one of the mandatory requirements for having a mortgage. Without property insurance, no lender will extend the mortgage. Condo fees or maintenance fees, if it happens to be a condominium apartment or a community of sort. Next would be repair and maintenance cost. While this is not a regular expense, it would be good to create a fund to address issues as they arise. I would suggest keeping, say, 0.5% to 1% of the value of the home as on an ongoing basis, so that you have some funds available to fix issues as they come. As we all know, things are only getting costlier, they are not getting cheaper. So, looking at all these expenses and obligations, it is critical that you budget not just for the purchase but for all ongoing expenses. Once you buy a home, these expenses are going to persist for as long as you continue to own the home. Well, if you pay off the mortgage, then that bit would eventually stop. To ensure financial stability and peace of mind, I would highly recommend that you look at your current financial situation, prospects, and make an analytical decision. Further, you need to be sure about your medium term plan, as unwinding home ownership, and I mean selling the home by that, comes with its own set of expenses, which can range between 5 to 7%. So, unless you are committed to following through and keeping up with these responsibilities on an ongoing basis, please do not venture out to buy a home. In the last section, we talked about the mental readiness to take on the responsibilities, and so we won't spend too much time on that over here. There is the readiness from a financial standpoint also that needs to be evaluated, and we'll cover that in the next section. So let's talk about the different professionals that you would need help from as part of this process. So, and by that I mean realtors, mortgage agents, advisors, lawyers, etc. I would recommend that you get your finances checked out first. And so you would need to start with a mortgage agent or a broker, and then have a discussion with your realtor in terms of finalizing what your needs are. So, one question that often arises is, how do you find good professionals to work with? And my recommendation would be to start with seeking recommendation from friends, family, and colleagues, and get a couple of references. Don't just stick with one, maybe get 2 or 3 references for each role. Speak with them and see if they fit your style. Way to check is if they are responsive enough to your communication. Buying a home requires quick action at times. So if your realtor or mortgage agent is not responsive enough, the process can become difficult for you. So that's one recommendation. Process of buying a home can also take a couple of months, and so it is important that you maintain your readiness. And by that I mean you remain employed or have your source of income not change. Make all your debt payments on time. Do not take additional debts, etc. So basically, maintain your status quo as far as finances are concerned. Once you identify a place you want to buy, you would of course need to secure a purchase agreement with the seller. Realtors will often hate me for saying this, but I strongly recommend that you protect yourself by having adequate conditions on your purchase agreement, or purchase offer rather, when bidding on properties. This could be, say, in the form of a condition of financing, inspection, appraisal, etc. Just have some sort of a way out in case you need it. This is paramount to protecting you from loss of deposit, financial stress, and lawsuits, etc. Of course, once you have obtained or secured your purchase agreement, You will need to engage a mortgage agent or broker to secure the final mortgage approval. And it could come with a number of conditions that the lender would want you to satisfy. That could be in the form of proving your income, employer verification, appraisal of the property, etc. And then finally, once all these conditions are satisfied, the purchase would be ready to close. So, this is the entire process in a nutshell. We have previously talked about the mental readiness to assume the responsibilities which come with home ownership, and so we won't focus on that bit here. The next two factors are something that you would need to work out in conjunction. That is, what is your realistic budget for the home, and what are the needs that are to be addressed in terms of features of the property. This can be an iterative process until you work out what is feasible. Your realtor and mortgage agent will definitely be of help as you work this out. An important factor to be considered is the amount of funds you would have available from savings, gift, or other means to put towards the down payment and the closing cost. Just to give you an idea, the closing cost can be as high as 1 to 2% of the purchase price, depending on the city you are buying in, major factor being the land transfer tax. The amount of down payment also strongly influences the amount of mortgage you can get. As far as income is considered, the lenders want to see a stable source of income from employment or business or some active source. And that would be factored into determining your mortgage eligibility. Salary is often easy to qualify, while business income or a source that fluctuates will need more supporting proofs. Credit score and track record of repayment is another important consideration. You could qualify with prime lenders and Big Five bank as long as the score is above 680. In some cases, maybe even about 650. But there are no blemishes in your repayment track record. Bankruptcy and consumer proposal can be challenging, especially if they are recent. Past bankruptcy involving a mortgage can be impossible to recover from, or wouldn't make sense based on the borrowing cost. One aspect that I find often ignored is the emergency funds. Job loss, illness, or something unfortunate can happen without notice. Expenses and mortgage obligations do not come to a halt even if the income dries up. So you should have the means to tide over a period, and I would say about 6 months, depending on your situation, so that you are able to recover from a situation and hence the need for emergency funds. Insurance protection is another often ignored aspect, especially in the thick of buying a home. Hence, I would recommend that you get this coverage even before you start looking for a home. If somebody is in a relationship and or has dependents, then insurance is a must have in my opinion. So why wait till you buy a home? Get a coverage that would be in line with what your mortgage obligations could be, or you can always top up the coverage if required once the home is finalized. But have something in place. Lastly, a formal pre approval before going out to buy a home. While it is not the same as the final approval, it would protect you from any sudden changes in interest rate, and you would have a fair understanding of what your mortgage eligibility looks like. Ticking off these items from your list will definitely set you up for success, not just with the purchase, but with maintaining ownership of the house. Now, let's turn our focus to the different types of lenders that we have generally access to. Not all lenders are equal, not all mortgage products are equal. Each have got their own distinguishing features and pros and cons. But generally speaking, all lenders will evaluate an application based on largely five criteria, and we call it in our mortgage industry the five C's of credit. And what are those? Those are capability or income, credit, which is a combination of score as well as your track record of repayment. Collateral, which is nothing but the property or the house on which the mortgage is against which the mortgage is secured on. Capital would be the down payment that you make when it comes to purchase, or it could be an equity that you have in the house if it is a subsequent transaction. And lastly, character. So character of the borrowers, are they consistent in whatever they are doing, and how have they generally handled credit? So those are the five, I would say, five aspects which determine what happens to an application. And each category of lender looks at it differently. So on top, the first item or the first row that we have is A lenders or the prime lenders. And those are typically your big five banks like the TDs, the Scotia, the RBCs of the world. And then you have some non-banking lenders in the same criteria like your First National, MCAP, CMLS, MCAN, RFA, etc. You also have credit unions like Meridian, Duca, and the others. So all of those would be your prime lenders, or at least they have prime products when it comes to mortgages. Their evaluation criteria is pretty much very strict, and they would look at all these five criteria, and there is very less room for any negotiation there. Next, we have B lenders or alternate lenders, and these are typically some banks, not your big five, but some other banks. And you also have some non-bank lenders or monoline lenders in this space, along with credit unions, which offer some B products or products with more flexibility in terms of these evaluation criteria. Largely, they would be flexible when it comes to income, or they would have different means to evaluate the income capability of the borrowers. They would maybe allow credit scores under 650. And they would be a bit flexible in case there's been any consumer proposals or bankruptcies, non-mortgage related in the past. Thirdly, we have private lenders, and these are usually institutional lenders, and we call them mortgage investment corporations as a terminology in our industry. And they are pretty much flexible on most aspects. Income may or may not be considered when it comes to evaluating the application. Credit score requirements are flexible. Collateral is where they are largely strict. And also they would be strict with respect to how much of equity or down payment you would have. Typically, the options like a B lender, alternate lender, or a private lender opens up only if you have down payment of more than 20% or you have an equity of more than 20% of the value. And bottom, we have private lenders, and these are individuals or corporations who are lending out their funds as mortgage or secured by mortgage, and they could be flexible on different aspects of it. There aren't any much strict guidelines which they have to generally follow. They would typically look at each case on a case-by-case basis and determine if they want to extend their funds as a mortgage or not. So this is pretty much the lay of the land when it comes to the different classes of lenders and how they look at different credit mortgage applications. There are several assistance programs supported by governments at federal, provincial, or local levels to help first-time home buyers with a purchase. Let's briefly touch upon them. So from the federal government, we have home buyers tax credit, and it provides a tax credit of up to $1,500 to eligible home buyers. Again, this is a combined figure available to all applicants involved in the purchase. Home buyers plan is an ability to borrow about up to $35,000 from your RRSP without incurring tax. This is to be repaid in full over a period of about 15 years, or otherwise it would get taxed. The first time home buyers incentive is a new program which has been launched by the federal government recently and only available for insured mortgages. Government may contribute about 5 to 10% of the purchase price as down payment for an equivalent share in the property. So it's sort of a second mortgage on the property that they would have. The first-time home buyers, the first home savings account is the latest program from the federal government, and it provides an ability to save $8,000 each year, and that is tax deductible. So it acts like a TFSA plus RRSP. You could accumulate or you could contribute a maximum of $40,000, so over a period of at least 5 years, towards the purchase of your first home. So these are some of the programs from the federal government. You also have some programs from the provincial government in Ontario, like the land transfer rebate, which is about $4,000 for first-time home buyers, or up to $4,000 for first-time home buyers. Combined with that, you also have a Toronto land transfer rebate, which is from the city of Toronto, and again, it provides an equivalent about $4,000 rebate to first-time home buyers. So in all, you could get a rebate of about $8,475 when combined with the Ontario land transfer tax. Then there is the GST rebate on new construction properties from the province. And that could work out to a maximum of about $24,000. That is sort of a rebate on the purchase price. Additionally, there are some grants and loans which are provided by some of the smaller cities and towns in Ontario. Okay, so now let's look at some of the common pitfalls when it comes to new home buyers and what they encounter. So first up, I would say I often find people who are not prepared mentally and financially, but they probably go ahead and secure a purchase agreement. And most often it even works out to be a firm purchase agreement, which then puts them in a tight spot because either the credit is not good, or the finance, they don't have enough down payment, or their income will not support the mortgage that they're wanting. So as I said, we talked about a couple of factors in our earlier sections and slides. So those are something that you would need to definitely take care of to be in a best position to buy the home. Next up, this is a recent issue that we have been encountering, wherein a long lead time to closing, and this is typically in the new construction domain, wherein purchase agreements entered into a couple of years back by the homeowners looked okay because they could qualify for that amount of mortgage at that point in time. But with changes in interest rate, that scenario can change by the time the property is ready for closing. And so in some instances, a long lead time to closing can change your financial situation quite drastically and make you ineligible for the mortgage that you would want or need to close on the purchase. Third up, we have again something that we touched upon briefly before, which is not having any conditions on purchase. So in case somebody goes ahead and secures a purchase agreement without any conditions, then they are bound to close on the purchase irrespective of their financing failing, or they finding issues with the property, or maybe the condo corporation is not in good standing, or any of those issues, and would not give them a leeway to walk out of that purchase agreement. Third up, we have consumer proposal bankruptcy. So again, if you go through any of these processes, there is a certain time period that you would need to we would need in order to rebuild your credit and to demonstrate to the lenders and the banks that you are ready to take on the mortgage. And so whenever you go through such a proposal, you would need to wait for a period of time before you can even think of buying a home. Then we have the issue of huge car payments. Car payments are an obligation, a monthly obligation, which would be taken into consideration by most prime lenders and B lenders when it comes to figuring out the mortgage eligibility. So if you have a huge car payment or a student loan or outstanding debts on your credit card or line of credit, then it is going to impact the amount of mortgage that you could carry. And also these sort of impact your credit score as well. Then we have the cases of unstable relationships. In case you are in a relationship which is not looking solid, then my humble advice would be to not go through the process of buying a home because to unwind the purchase, it is a it's a very costly process, and which can take you anywhere between 5 to 10% off the value of the home, just to cover the brokerage fees on the sale, any penalties that you would encounter um, towards breaking the mortgage, and things of that nature. So it can quickly add up. So if your relationship is not on steady grounds, I would say do not even think about going and buying a house in joint name. Lastly, buyer's remorse. So again, as I said, each transaction is costly. You incur a lot of funds paying the transfer fees, the lawyer fees, penalties to break a mortgage in case you want to unwind. So buying a home is not like buying a stock from a stock exchange, and the fees and penalties involved are way too high. So you need to be sure about what you're purchasing and why you're purchasing, and whether it is going to suffice your needs for the immediate future. So if you're not sure about any of those things, then I would say you have to reconsider your thought of buying a house or what you're planning to buy. This is sort of the high-level view on some of the pitfalls that I have seen. Within my within my practice. I just want to highlight. As we come towards the end of this webinar, let us quickly tackle some mortgage myths. First up, let's tackle the myth that the lowest rate is always the best rate when it comes to mortgage. Sure, it's tempting to focus solely on the interest rate, but like choosing peanut butter, there's more to consider than just the price tag. Just think about it. When buying peanut butter, you consider factors like quality, taste, and nutritional value. Similarly, when it comes to mortgages, there's a lot more at play than just the interest rate. I'm often surprised when borrowers only ask about the lowest interest rate. Don't get me wrong, interest rate matters, but it may not be the true reflection of the cost of the mortgage. Consider factors like prepayment options, penalties for breaking the mortgage, any restrictions during the term of the mortgage, ability to re-advance principal, customer service, and more. All of these factors impact the true cost of the mortgage. So do not let the lowest rate myth spread. Make an informed decision that is right for you, even if it is different from what your friend might choose. Next up is the credibility of lenders other than the big five banks. You see, we have a wide range of lenders to choose from, and you would have seen that from the previous slides. All of them are highly regulated by the dedicated federal or provincial authorities, maybe not just the private individual lenders. So each lender has its own niche offering, and it is essential that you work with a knowledgeable mortgage agent or broker who can guide you through this landscape. Next, let's address mortgage eligibility. Did you know that the same person may get approved for different mortgage amounts among different lenders, maybe even among the big five banks? That's because each lender has its own policies and risk appetite. So if your bank declines your mortgage or won't approve the amount that you need, don't be discouraged. Work with somebody, maybe like a mortgage agent or broker, who can provide a more realistic view on what your eligibility looks like. The same goes for self-employed individuals. Different lenders evaluate self-employed income differently, and so you may have more options with a non-big five bank. Again, it is crucial to work with a mortgage agent who understands the space to get the best outcome for you. And now lastly, let's debunk the myth that all mortgage agents and brokers are the same. Each of us have our own specialities and niches. For example, my focus is on helping clients finance rental properties and implementing strategies to reduce mortgage costs and income tax. But other agents might specialize in helping clients with poor credit or securing private mortgages. So it is important to find a mortgage professional who aligns with your specific needs and goals. With this, we have reached the end of today's presentation. In conclusion, I would just say navigating the real estate market and home buying process can seem daunting, especially for first time home buyers. But with careful planning and right guidance, it is entirely achievable. By understanding the current state of the real estate market, this budgeting for the costs and responsibilities of home ownership, and leveraging available assistance programs, you can position yourself for success in achieving your home ownership goals. Remember to avoid common pitfalls, mortgage myths, and seek professional advice when needed. With diligence and determination, you can confidently embark on your journey to homeownership and enjoy the many benefits it brings. Thank you for joining us today and best of luck on your path to homeownership. If you have any further questions or would like to know more, do not hesitate to reach out. My contact details are on the screen. Thank you.